Wednesday, May 20, 2026. NVIDIA delivers a staggering $81.6 billion in quarterly revenue, an 85% year-over-year explosion, crushing estimates. The momentum doesn't stop there. SpaceX files for a historic IPO. Home Depot delivers a massive beat. The corporate engines are roaring. But this chart shows a completely different reality, a plunging downward trend line for the broader market. Despite the incredible corporate news, the S&P 500 is logging its third consecutive day in the red. The Dow is dropping hundreds of points. Even NVIDIA falls immediately after its blowout report. Retail investors are scrambling for an explanation. They read the news, see Walmart warning about fuel costs hitting $4.55 a gallon due to conflicts in the Middle East, and assume consumer jitters are driving the sell-off. But those headlines are just noise. To understand why spectacular corporate profits triggered a broad market crash, you have to stop looking at stocks entirely. You need to look at an invisible force pulling the strings from the outside. That force is the bond market, specifically United States Treasuries. During that exact same week in May, government bond yields experienced a rapid, historic upward spike. You can think of the bond market as a gravitational pull acting directly on the entire financial system. When that gravity intensifies, it ruthlessly drags down the valuations of riskier assets. It does not matter if a company like NVIDIA is doubling its revenue. The sheer weight of the bond market pulls the stock price down with it. We measure this gravity using 10-year and 30-year U.S. Treasury yields, the risk-free rate. Backed by the government, investors assume zero default risk. But on Tuesday, May 19th, the 30-year yield spiked to 5.198% intraday, a high not seen since 2007. This surge wiped out market expectations for Federal Reserve rate cuts in 2026, creating an immediate trial-by-fire crisis for new Fed Chair Kevin Warsh. For major institutional investors, this changes the math entirely. If you can suddenly get a guaranteed 5% return just by holding a government bond, the gamble of buying tech stocks becomes far less attractive. This dynamic is defined by a core mathematical equation, the equity risk premium. It is the mandatory extra reward investors demand to justify taking on stock market volatility instead of sitting safely in bonds. Let's put numbers to it. If the stock market traditionally returns about 9% a year and the risk-free bond yield is sitting at 4%, your equity risk premium is a comfortable 5%. But look what happened on May 19th. When the risk-free rate surged past 5%, that comfortable premium shrank. Suddenly, stocks were mathematically too expensive relative to the safety of bonds. To restore balance and attract buyers back, the overall expected return of the stock market has to go up to rebuild that premium. Here is the brutal reality of market math. To increase an expected future return, you must buy in at a cheaper price today. For the expected return to go up, current stock prices must drop. That is exactly why the market sold off heavily despite record-breaking profits. Investors were demanding cheaper prices to justify the risk. By Friday, May 22nd, the pressure finally broke. The 10-year Treasury yield retreated from its weekly highs, falling back down to 4.558%. The relief was instant. With bond yields falling, the math balanced out. Growth stocks and small caps had room to breathe again, pushing the Dow up 294 points to a brand new record close of over 50,500. Watching the evening news, you might think this recovery happened because President Trump called off an attack on Iran, citing peace negotiations.
Geopolitical headlines like that are great at driving temporary sentiment. But underneath the noise, it is the raw, unfeeling mathematics of bond yields that actually dictate where trillions of dollars flow. For long-term investors, the lesson from that chaotic week is clear. Don't get distracted by day-to-day corporate earnings beats or scary geopolitical headlines. Keep your eyes on the risk-free rate. Understanding the equity risk premium gives you a navigational compass. It explains the mechanics of how money is actually valued, giving you clarity while the rest of the market panics. To see how this affects your own portfolio, head over to longruninvest.io. You can use our interactive equity risk premium calculator to visualize how changing bond yields impact the premium you earn for holding your specific stocks.